Welcome back to the deep dive. If you've ever wondered what happens when, the absolute pinnacle of financial theory meets the absolute worst of human panic, then, well, buckle up.
Yeah, this is quite a story.
Today, we are opening the file on long-term capital management, or LTCM. This was a firm so mathematically sophisticated that its catastrophic failure back in 1998 nearly took the entire global financial system down with it.
It really did.
It's the essential cautionary tale, really encapsulated by that title, When Genius Failed.
Exactly.
So our mission today is a deep extraction. We need to go past the headlines and really understand exactly how the smartest people in the room, and they really were considered that,
Oh, absolutely. The best minds.
how they built what they were convinced was a flawless money machine, why their, Nobel Prize-winning math completely broke down, and what essential lessons about risk and, frankly, hubris they left us with.
And this story is just vital, not just for market history buffs, but for understanding how risk operates today. LTCM is, it's the perfect case study in the dangerous limits of quantitative modeling.
The math limits.
Exactly. And the devastating power of unseen leverage and, the cold, hard fact that history is often a terrible predictor of market behavior when panic really sets in.
Okay, let's unpack this financial dream team then, because like you said, this wasn't just some anonymous startup. This was, the financial equivalent of the Avengers, right?
Pretty much. Founded in 1994, LTCM was led by John Merriweather. He was already a legend, a top bond trader from Salomon Brothers.
Right, a Salomon guy.
Merriweather brought the trading muscle to the street smarts, but the real intellectual firepower, that came from the academic side. The headline members, the ones who gave the fund its aura of infallibility,
You geniuses.
were Nobel Prize-winning economists Myron Scholes and Robert C. Martin.
Okay, now this is crucial. They won the Nobel for their work on the Black Scholes model, which helps value options and critically measure volatility, right?
Precisely.
How did that academic triumph translate into their actual day-to-day strategy at LTCM?
Well, that's the core of the genius factor, isn't it? Their work provided this framework for quantifying derivative risk. So Merriweather pitched investors on this irresistible idea, combining Wall Street intuition with models that could predict and manage risk with, well, what they thought was near scientific precision.
Like a formula for making money.
They were absolutely convinced they had mastered the mathematics of volatility and risk. They weren't just aiming for high returns, they were aiming for guaranteed high returns, or as close as possible. They truly believed they'd built an unstoppable money-making machine by almost eliminating random chance.
So if they were so brilliant, how exactly did they put this model into action day to day? What was the actual trading strategy?
The core strategy was something called relative value arbitrage. It sounds simple on the surface, but they specialized in the most complex, often hard-to-value instruments.
Can you elaborate on that difference? Because it sounds like more than just buying bond A, because it's a tiny bit cheaper than bond B.
Right. Much more complex. They'd identify two distinct assets, maybe say a long-dated interest rate swap and a specific type of government bond, things their models said should trade in a very tight correlated range.
Okay.
If that price difference widened, maybe irrationally widened for some reason, they'd buy the cheap one and sell the expensive one. They were betting that the gap would inevitably converge because, statistically, looking back at historical data, it always had.
So they're exploiting these tiny, fleeting inefficiencies.
Exactly. In the pricing of complex stuff, often illiquid instruments like, emerging market debt or really esoteric derivatives, things most people wouldn't touch.
And because these differences were often just fractions of a percentage point, fractions of a penny sometimes, that brings us to the elephant in the room. Leverage. How did they amplify these razor-thin profits into those incredible 40% annual returns they were seeing early on?
Yeah, those returns were huge. And it required two, dangerous necessities. First, enormous volume. They had to do these trades in massive size.
Okay.
Second, massive leverage. The profits were thin, so they used borrowed money. We're talking trillions of dollars over time to make the trade size absolutely gargantuan.
Wait a minute. If the whole premise was risk elimination and mastering the math, how did the smartest people on Earth justify a leverage ratio that, reportedly reached $100 borrowed for every $1 of their own capital? Wasn't that the fatal flaw just staring them in the face?
Well, their justification was rooted entirely in the math. They believed their historical models, which relied heavily on the Gaussian distribution, the famous bell curve.
Right, the normal distribution.
Exactly. They believed that meant extreme events, these massive outliers, were statistically Well, practically impossible.
Hmm.
They saw leverage as just maximizing the returns on what they viewed as a statistically certain bet.
So the risk wasn't really risk in their eyes.
They thought they had quantified it, controlled it. They truly believed their models could anticipate and manage any fluctuation within a certain, very high confidence interval. The risk was just a number they could manage.
That is just staggering confidence, 40% annually. I mean, that's the kind of number that makes even normally cautious investors maybe ignore some red flags.
And that phenomenal success absolutely bred hubris. Our sources show that as they kept winning, they grew sort of isolated. They started dismissing warnings from their own counterparties, the banks lending them money,
They thought they knew better.
and they started taking on even riskier, more complex bets. They kind of stopped respecting the structure of the market itself because they genuinely thought their models transcended it.
The market, however, well, the market had other ideas, didn't it? When did the external world start throwing curveballs that their historical models just couldn't catch?
The initial cracks, the first real warning signs, appeared in 1997. That was the Asian financial crisis. Suddenly, assets that had always been tightly correlated started moving very differently. Predictable market patterns just broke down.
Because the models were built on past history.
Exactly. The models were built on history, but the market was heading into uncharted territory, and it was being driven by fear, not historical patterns.
And then came the true knockout blow. An event so far outside that statistical bell curve that the Nobel-winning math couldn't even, register it properly?
That was August 1998. Russia defaulted on its government bonds. Now, this wasn't just some localized economic event. It sent a tidal wave of pure panic through global markets. It turned basically all financial assumptions upside down overnight.
Okay, so tell us exactly why a Russian default was so devastating to a firm betting on, say, converging prices in instruments like U.S. bond swaps or Danish mortgage bonds. What was the connection?
Because in a true panic, every single investor rushes for the safest thing they can find, which usually means liquidity, cash, and the safest government bonds, like U.S. Treasuries.
Right, the flight to quality.
Exactly. They fled from everything perceived as risky, including many of those complex niche instruments LTCM was holding huge positions in. They piled into the absolute safe havens, primarily U.S. Treasury bonds.
So the price gaps that LTCM was betting would close. They didn't close like the models predicted.
They did the absolute opposite. The gaps between the safe assets and the risky assets, the very gaps LTCM was betting trillions on closing, they blew wide open. Wider than anyone thought possible.
Why?
Because the panic created completely irrational pricing. People were selling assets not based on their true fundamental value, but based on what they could immediately sell to raise cash to get liquid. And because LTCM was active in so many different but correlated markets simultaneously, every single one of their highly leveraged trades started going catastrophically wrong at the exact same time. It was a perfect storm hitting every position.
The market had just completely rejected the statistical certainty they'd built their entire empire on. And because they were leveraged, over 25 to 1 on average?
Yeah.
How quickly did the losses pile up?
It was incredibly fast. In a matter of just a few weeks, they lost $4.6 billion. The fund was basically insolvent. But the real danger, the systemic danger, was actually just beginning.
Right. This is where the story shifts, doesn't it?
Yeah.
From just a massive trading loss at one firm to a genuine systemic crisis for everyone. Frame this for us. Why did the failure of this one, albeit large, hedge fund become such a threat to global finance?
The threat wasn't just the $4.6 billion hole in LTCM's own books. The huge problem was counterparty risk.
Meaning who they owed money to.
Exactly. LTCM was essentially this black hole of debt. They had borrowed astronomical sums from almost every major bank on Wall Street. Goldman Sachs, JP Morgan, Merrill Lynch, Deutsche Bank, you name them, they were involved.
They were all exposed.
Massively. If LTCM had simply defaulted and gone bankrupt, which it was about to do, those banks wouldn't just lose the billions they'd lent LTCM. They'd also be left holding the bag on thousands of complex, outstanding derivative contracts. Contracts that suddenly had no clear value and, critically, no solvent counterparty on the other side.
That chain reaction.
A potential domino effect. This sudden, simultaneous hit to the balance sheets of all major global lenders threatened to completely freeze the credit markets worldwide. No one would trust anyone else. No one would lend. It could have caused a complete global financial meltdown.
Wow. So the U.S. Federal Reserve, led by Alan Greenspan at the time, decided they absolutely had to step in. What was the response? It was pretty unprecedented, wasn't it?
Highly unprecedented. The Fed stepped in and essentially orchestrated a $3.6 billion private bailout. Now, crucially, they didn't inject taxpayer money directly.
That's important.
Very. Instead, they essentially locked the leaders of the 14 major lending banks, the counterparties who had the most to lose if LTCM collapsed in a room at the New York Fed.
And told them to fix it.
Pretty much. They effectively forced these banks to put up the necessary capital, take over the failing firm, and then slowly, carefully unwind its massive, incredibly convoluted portfolio of trades over several years. It was an emergency intervention based on the premise that LTCM was simply, well, too interconnected to fail.
That history is just sobering. Okay, let's really nail down those ultimate takeaways about intellect and risk. What are the profound lessons from when genius failed that still resonate so strongly today?
Well, lesson number one, I think, has to be about the limits of data. Relying purely on historical data, say, the last 20 years of relative market calmness will never fully prepare you for the sudden, statistically improbable black swan event.
Things that have never happened before.
Exactly. The market isn't a closed system you can perfectly model. The fundamental rules can and do change in a real crisis. History isn't always a reliable guide.
And the second big lesson comes back to that structural flaw we talked about, the leverage.
Absolutely. Leverage isn't inherently evil. It's a tool, but it must be respected. LTCM demonstrated perhaps better than anyone that leverage is a brutally double-edged sword. It amplifies profits fantastically on the way up.
But it amplifies losses just as much or more on the way down.
Exactly. Their system, relying on that massive leverage, left absolutely zero margin for error. It turned what should have been maybe a painful but standard market correction into an existential crisis for the entire financial system.
So if we try to connect this to the bigger picture, the core synthesis point here really seems to be that the math, the brilliant math, failed because it forgot about the human element, right?
That's fascinating, isn't it? Because no model, no matter how sophisticated, no matter how many Nobel laureates design it, can ever fully capture raw human emotion.
Fear and greed.
Scholes and Merton's genius calculated volatility and risk under what they assumed were, let's say, normal or near-normal conditions based on the past. But in August 1998, pure fear, blind panic, and total irrationality, not statistical logic, were driving the markets.
The models couldn't compute panic.
Precisely. The market, ultimately, is always smarter, or at least more powerful, than the mathematicians when it decides to become purely emotional.
Which means that maybe humility and a deep respect for the unknown, rather than just absolute mathematical confidence, are maybe the most valuable assets you can carry in finance or maybe anywhere.
Exactly right. The ultimate lesson might just be that you must always acknowledge that the market can remain irrational far longer than you can remain solvent.
That is a truly powerful examination of how theoretical perfection just collided head-on with messy, unpredictable reality. Thank you for guiding us through those sources today.
My pleasure. It's a critical story to remember. And maybe as a final provocative thought for you to mull over. Since LTCM's catastrophic failure demonstrated pretty clearly that human emotion always seems to break the sophisticated math during a major crisis.
Yeah.
Think about the incredibly complex financial systems built today. All the derivatives, the algorithms, the high-frequency trading. What sophisticated system out there right now might be relying too heavily on models that are maybe mathematically guaranteed to fail exactly when we need them the most?
An excellent and slightly unnerving question to end on. That's all the time we have for this deep dive. We hope you feel better equipped to understand the true cost of leverage and, yes, the dangerous limits of genius. Until next time, stay curious.